And joining me now with more as the market has opened is Jim Bianco. He's a president and macro strategist at Bianco Research. Jim, it's great to have you on here on this Friday, and stocks taking a pause today after some volatility that we've seen this week. What should our viewers make of it?
You know, it seems like that the bond market or interest rates are reasserting themselves on the stock market, the credit markets, and a lot of other risky markets. The Federal Reserve cut rates on Wednesday, hinted that they might cut rates again into 2025. But if you read the wording of what they said, it was actually an argument to raise rates. So it left the market a little bit confused, I think, and unsure about the Fed's commitment to tackling what seems to be an incipient inflation problem. We can't get the inflation rate anywhere near their target of 3%. And if the Fed is not going to be serious about fighting inflation, maybe bond investors aren't going to be serious about owning bonds, and higher interest rates are going to bother everything, not the least bit the stock market.
So what does this mean, Jim, for equities going forward? Investors have seen the volatility this week. I think they're wondering, is it likely that this could last?
Higher rates could last. I think that's definitely the case. But for investors, this is not 2019. This is not There Is No Alternative or TINA. This is a bond market now that high quality investment grade bonds can give you about a 5% return, or at least a 5% coupon year in and year out. With the stock market, given its current valuations, what should you expect the stock market to give you year in and year out over the next several years? Probably about 6% or 7%. I know we've had 25% years in the last couple of years, and I know everybody wants to believe that that will continue. Maybe it does for another year or two, but given the valuations, you shouldn't expect more than 6 or 7%. In other words, the bond market is now real competition for equities. So people could say, look, I could reach for the stock market and over many years look for a 6% return with a lot of volatility, or I could get a 5% return in the bond market with a lot less volatility.
Here's a question for you, Jim. We saw the president-elect Donald Trump here at the stock exchange just last week, joined by his family and many members of his cabinet, including the Commerce Secretary, as well as his pick for Treasury Secretary. We've seen clues that the president-elect wants the stock market to perform well. How does that factor into all of this?
Oh, I think it factors in a lot, that the expectations are the government is going to be very stimulative. There will be tax cuts, there will be deregulation, and maybe on the inflation side, there might be a little bit of tariffs. So you could look at this and say, great, that means earnings are going to probably be doing well. That means investors will be confident to buy stocks. Yes. But on the other side of the equation, that means that bond investors are going to say, I'm out of here. And you're going to have to contend with ever higher levels of interest rates. And as I said, if you think that the stock market has a 6 or 7% return over the next several years, and that's a realistic option, then the bond market, if yields continue to go higher, will provide that counterbalance or that competition, something we hadn't seen until very recently from bonds.
Interesting. So I do want to ask you, Jim, about this potential government shutdown that could happen tonight. We had seen some of the weakness in equities early this morning after a House bill failed to pass late yesterday. How does that factor in?
Well, keep in mind the big thing about this shutdown is that it will not result in any kind of a government default on the Treasury debt. That it's always the debt ceiling limit is not due until January 1st, and then the Treasury has what they refer to as extraordinary means that they could probably push off a potential default for several months. So a government shutdown, you have to view it kind of like you would view a drastic federal spending cut, because that's effectively what it is. It means that the government's going to spend less money. It means that the government is going to have less, optional services. Essential services will continue. And some workers will get furloughed, but at the end of the day, everybody will get paid. In other words, I would argue to you that a government shutdown is probably bond bullish more than anything else. But given the cross currents of inflation, strong growth, stimulus from a new administration, that's not playing in the bond market right now. But I don't think it is necessarily a catastrophic financial market event unless you have me back in 2 months and we're still in a government shutdown. Then it might start to metastasize into something worse.
Jim Bianco, president and macro strategist at Bianco Research. Jim, thank you so much for joining.
Thank you.